But there are some tips that I can give you for enhancing your swing trading. Now, swing trading, we can take long and short positions within a bullish trend in the same way that we can take short and long positions within a bearish trend. This is what swing trading is all about, really. It's about sort of trying to capture as much of the market as possible. However, there is an intrinsic risk with trading against the direction of a trend, and so there are methods that you can reduce your risk of 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 getting it wrong, basically, by doing things like reducing your exposure to counter trend trades. This is simply trading with smaller trades when you're trading against the trend. You don't have to do this, but this is a method of reducing the risk of trading counter trend. Um, Take profit more readily for counter trend trades because you're trading against the trend. The downside, unless there's going to be a break of trend, is likely to be much shorter in a bullish trend, as we saw in the euro dollar example that we just had. And also, if you're not 100% sure about it, this is a bullish trend in euro dollar that we've just been observing. If you're not 100% sure about entering short, then skip it. It's easily the safest opportunity. But it's important to know where to take profit, and this is sort of an element of swing trading. Is if you're not going to be trading counter trend, which a lot of people don't, then it's important to know that you are maximizing the profit of your trade. So you're going to want to be taking profit at the best possible prices and then letting price come back to where you feel comfortable entering long again for a bullish trend. Um, and it's also very, very important to have a clear understanding of when a trend is broken. And again, one of my preferred methods for doing this is to draw channels on charts, as I gave the example on the euro dollar chart. Um, my fourth tip is one of the most important things in trading. Wait for confirmation from price before entering. So many traders try to guess tops and bottoms, and so many novice traders try to guess tops and bottoms. And guessing tops and bottoms is extremely, extremely difficult to get right. And the success rate of guessing tops and bottoms is some people are good at it who are extremely experienced, others are not so good at it. And it's an extremely challenging thing to do, and it's not something that's recommended at all. However, if you have a position and you're pretty sure that it's not going to get past, say, the AB versus CD, um, you know, swing within a trend, then it is prudent to take profit sometimes from, from these highs, because quite often you might get, a better price. However, this is again determined by how aggressively you want to be trading. It would be quite an aggressive thing to just take a profit without a confirmation there has been a change of trend, because you might then be in a position where trend continues and you're missing out on upside for a bullish trend. So it is recommended that you wait for confirmation, and I'm going to show you exactly what I mean by that. Okay, now here we have the channel that I mentioned before. Now this is one of my favorite methods for defining a trend. It's simply just parallel lines that are drawn between significant points within the trend. And what we're aiming to do is we're aiming to find a gradient for the line. We're aiming to find 2 points whereby you can just move the line around within the chart and move them to significant points. So you can say, copy and paste this line here to this line, and it will define a top, very neatly. Or, this top's particularly good. This is, a very perfect rejection from this resistance here. And so this channel is a very good method for non-horizontal support and resistance. This is sort of, this can be thought of as support and resistance for the trend, rather than price support and resistance, which we've described as horizontal with these fib retracements and fib extensions. Now we started onto this by saying that we wanted confirmation before we entered into a trade, and let me give you an example of this. Now we've had this continuation of bullish trend. We've bounced off the 100% fib extension, this AB equals CD, and we've had a strong retracement. Now this is a very strong rejection from this price. So automatically, this is people entering short. This is people with a lot of conviction that price is coming down from here. And this is the kind of thing that will, you know, when you see such strong conviction in the market, you should be very, very cautious about trading against it, because this is this is a strong move down. However, it's been a strong move down, and we've met this support area here, this place here, and there has clearly been a reduction in how bearish people feel about this particular move at this particular price. So there has been a lot of trades that have changed hands here. And again, we've had another pin bar here. Now, we have, quite a modest body, but quite a long pin on both of these. Like the tail on both of these is very long. And so this means that from this sort of level, we're seeing people enter the market. This is momentum carrying price down, and people closing shorts here, or people entering long around this sort of price. And then sure enough, we've had this rejection, and we've had, further pin bars here, these long tails indicating rejection from this support once again. This is what we want to be looking for. We don't want to be entering long, at support, because you don't have an indication of which support to choose. We've blown through 3 levels here. So you don't want to be entering short here, because you'll be in deep trouble by the time you're down here. You want to be sort of mindful of where this support and resistance is. Then you want to be waiting for price action confirmation that this is the support level or the resistance level, that something is going to change, because this is the safest way to avoid entering and losing money. This is increasing your probability of a successful trade. My last tip is learn typical breakout behavior. Breakouts happen when there is a very strong level, and there's a lot of demand, which is preventing the price, demand or supply, that is preventing the price from moving beyond that level. And it eventually chips away at it, and it chips away at it, and it eventually breaks through the level once the people who, are entering the trades or taking profit from the trades at that particular level, once they have run out of willingness to continue, then the level will break, because there will be, all of the orders will have been taken up by people that are convinced that the trend will continue. However, once a level is broken, a typical market behavior, this doesn't always happen if there's a particularly strong breakout and there's a particularly good reason for it to keep going, but there is a very strong tendency for breakouts to retrace to the level that they've broken out from. So you'll get this effect where you've broken through a level, and then prices come all the way back to the level that was broken, and then you've seen people enter at this level once again, now that they've if they were trading in the opposite direction, they've had a chance to close their trades, or if they're people wanting to jump onto this trend now that they've seen this breakout, then this is a place where everyone's going to enter. And so again, this is another area where we can expect to see price action, which will be supportive of us entering a trade. And so if I go back to this slide back here, and I'll show you some breakouts. Okay, now we've had this level here, we've had this, this break of a new high, and we've had a continuation, and we've had this breakthrough resistance here, and it's broken through, and it's gone beyond it, and it's retraced back to support, and we've started to see these bullish candles again, these pin bars. This is a very small pin bar, but it's a pin bar nonetheless. This is still an indication of a rejection from this price. And so we've had this breakout, and we've had a push back to the broken resistance, and then we've had a continuation up to the next level. As another example, we've had this break of resistance here. It's gone beyond it, and then it's come back to the price, and there's been people enter here, and we've got this pin bar here, this bullish pin bar, and we've gone back up to this level again. And this is something that you see time and time again. It's a very common thing that you see in in trading. And interestingly, at the moment, as a very good example, is we've just had a break of trend for euro dollar. Now, this doesn't mean to say that there's going to be an end to upside. It just means that this particular method of defining the trend means that it has broken out. And so we've had a breakout here. We've broken through this major support here, this major trend line, and we've gone to the downside and we've had a rejection. Now, the reason this has happened is because the ECB have started talking quite firmly about cutting rates and adding extra stimulus. So this is a fundamental reason that this has happened. However, nevertheless, I wouldn't be entirely surprised if we saw a retracement back up to this sort of level before we saw a continuation of downside and a new trend, if we're going to see a new trend at all. If we see the ECB instigate some policies that will move the price of the euro much lower. So this is again, a perfect example of a breakout. We've had this break of trend, and if you entered short now euro dollar, you would be risking, you know, you might get lucky, but you would be risking the retracement back to the broken level. Um, and so you're placing yourself at a slightly higher risk of losing money here. Um, and these are my top 5 tips. I look forward to chatting to you again.